Kirloskar Ferrous Industries, a company that's grown its profits 5x in the last 10 years. Sounds impressive, right? But wait, despite these booming numbers, the company has spent over Rs 300 crore in building plants and upgrading infrastructure. And yet, it hasn't generated a single rupee of free cash flow. So the question is Kirloskar Ferrous a hidden gem building for the future, or a company trapped in an endless reinvestment loop? In this video, we'll decode every layer: its products, financials, cash conversion, risks, and strategy. So even a beginner can understand whether this business truly creates wealth or just good-looking reports. To truly understand Kirloskar Ferrous Industries, we need to forget the stock for a moment and study the business like a partner would. So what does KFIL actually do? In one line, it makes the raw materials and finished parts that go into the backbone of India's economy: tractors, trucks, and engines. KFIL is part of the 130-year-old Kirloskar Group, one of India's oldest industrial houses. It began operations in 1991 and today runs 3 integrated manufacturing plants, located in Koppal, Karnataka, Solapur, Maharashtra, Hiriyur, Karnataka. These plants are strategically located near auto hubs in the south and west of India. KFIL operates in 3 main segments. A. Pig iron. This is a base metal, the raw material for making various iron and steel products. KFIL produces pig iron in-house using its own blast furnaces. B. Foundry and casting. KFIL manufactures engine blocks, cylinder heads, and other critical auto components. These parts are supplied to some of India's biggest tractor and commercial vehicle companies. C. Machining. Beyond just casting, KFIL now machines the parts to near-finished quality. This gives it more control, higher margins, and long-term supply contracts. So it's not just a metal seller, it's a Tier 1 supplier to India's mobility sector. KFIL is an integrated player, meaning it controls multiple stages of its supply chain. It produces its own pig iron, uses that to make its own castings, machines those castings into ready-to-fit components. This vertical integration gives it 3 advantages: cost efficiency, supply chain control, pricing power. In peaceful investing terms, this is a business that builds its own moat, not rents it. KFIL's customers are some of India's top original equipment manufacturers: tractor makers like Tafi, Escorts, commercial vehicle players like Ashok Leyland, Tata Motors, engine manufacturers like Cummins. KFIL also exports castings to the US and Europe, a growing segment. Let's simplify the business strength in 3 points. Control. It makes core inputs and core products. Consistency. It serves large clients with recurring demand. Capability. It has the technical expertise for quality and precision. That's not just manufacturing, that's industrial compounding. And that's what gives KFIL the potential to grow steadily, without chasing fads, overpaying for raw materials, or relying on price cycles alone. For investors seeking peaceful compounding, this kind of business model is a solid foundation. Understanding a business financially means asking one big question: is it growing in a way that builds long-term value? Not just revenue, but efficiency, returns, and real cash. Let's explore how Kirloskar Ferrous has performed across a full decade, from FY16 to FY25. We'll cover 5 critical checkpoints: sales growth, profitability, return ratios, balance sheet discipline, and dividend signals. Sales 6x growth engineered steadily. KFIL's top line grew from Rs 114 crore in FY16 to a projected Rs 564 crore in FY25. That's a 6x growth, or a CAGR of 21%. This wasn't luck or a one-time trigger. It came from expanding iron casting and pig iron capacity, adding new business lines like DI pipes and steel, the acquisition of ISMT Limited. This reflects a decade of disciplined execution, not stock market noise. EBITDA profits that scale with revenue. EBITDA has grown from Rs 153 crore in FY16 to a projected Rs 809 crore by FY25, over 5x growth. Margins started at 13.8%, and have held mostly between 13–16% despite inflation and expansion. That stability tells us the business has pricing power, internal efficiencies are working, and growth has not diluted profitability. Profit after tax resilient and steady growth from Rs 58 crore in FY16, PAT rose to Rs 294 crore by FY24, a 5x plus increase. Even in FY21 during COVID, the company stayed profitable. It didn't boom and bust. It grew consistently, like a reliable engine. ROCE and ROE, the honest picture. Now here's where a careful investor pays attention. ROE dropped from 16% in FY17 to 8.85% in FY25. ROCE also dropped from 17% in FY17, peaked at 22% in FY21, and dropped to 8.85% in FY25. Why has this declined? The company has made large capital investments, especially after acquiring ISMT. These new assets haven't been fully contributed yet. The returns may look subdued now, but this is a transition phase. Investor insight. This dip is understandable if ROCE and ROE recover with revenue growth in FY26 and beyond. It's a key metric to track, because return ratios are like the health of the engine: debt, dividends, and capital discipline. Across 10 years, KFIL managed to fund Rs 336 crore in CapEx, keep debt to equity below 0.4x, and grow dividends from Rs 17 crore in FY16 to Rs 91 crore in FY25. This tells us the company has not just grown, but done so with discipline and shareholder respect. These numbers prove that Kirloskar Ferrous is not a short-term performer. It has grown revenue, profits, and capacity, and is now poised for ROCE recovery. It's a long-term story still unfolding, and for a peaceful investor, those are the best kind. Up next, let's see if this growth translates into actual cash in our cash flow analysis. Profit looks good in reports, but only cash can pay salaries, buy assets, or return value to shareholders. In this scene, we go deep into the real cash story of Kirloskar Ferrous, from FY16 to FY25. The key questions are profits translating to real cash? Is the company investing wisely? And is there anything left over as free cash flow? CFO versus PAT. Are profits real or just on paper? Over FY16 to FY25. Cumulative PAT, net profit, Rs 2,072 crore. Cumulative CFO, cash from operations, Rs 336 crore. That's Rs 264 crore more in cash than reported profit. Why? Because Kirloskar Ferrous has strong working capital discipline, customer collections, limited non-cash adjustments. This means profits are real, not accounting illusions. For investors, that's a green flag. CapEx building for tomorrow, not overspending between FY16 and FY25. KFIL invested Rs 336 crore in capital expenditure. That includes new plants and machinery, DI pipe capacity, steel integration, the ISMT acquisition. This CapEx isn't random. It's long cycle and aligned to strategy. It may weigh on short-term ROCE, but builds the base for long-term growth. Free cash flow. What's left after all this? Free cash flow =CFO CapEx. Cumulative FCF from FY16 FY25 is Rs 1,000 crore. Yes, it's negative, but here's the key insight. The business generated cash, it reinvested that cash, it chose to grow, not just sit on liquidity. This is expected for a company in expansion mode, especially in capital-heavy sectors. FCF-CFO ratio. How much cash was actually free? This ratio helps investors see the freedom after essentials are paid. KFIL's FCF-CFO =, 30%. That means most operating cash was reinvested, a reinvestment phase. If those investments improve ROCE and EBITDA in future years, this will prove to be a smart move. How did they fund all this without panic? Despite negative FCF, KFIL did not dilute equity heavily or take on risky debt. Instead, they used efficient working capital, internal accruals, debt carefully, debt to equity approximately 0.4x in FY25. In fact, without the Rs 336 crore in CFO, they would have had to raise far more capital, risking dilution or high interest costs. So yes, free cash flow is negative, but the business is not bleeding, it's building. This is what strategic reinvestment looks like. As ROCE and EBITDA expand from FY26 onward, the payoff will show. And that's the mindset of peaceful investing. Watch the roots, not just the fruit. Next, we'll study how efficiently Kirloskar Ferrous is managing its inventory, payables, and receivables in working capital efficiency. Cash might be king, but working capital is the heartbeat. How efficiently a company moves goods, collects payments, and manages its supply chain tells us everything about operational discipline. In this scene, let's study how Kirloskar Ferrous manages working capital, the silent driver of liquidity, profitability, and debt control. Working capital is the cash tied up in inventory sitting in warehouses, receivables waiting to be collected, and payments owed to suppliers. The faster this cycle moves, the stronger the business becomes. Think of it like a restaurant. Quick inventory turnover = fresher meals. Fast collections = more cash on hand. Delayed payments to suppliers = better float. That's efficiency, and it's measurable. Formula: receivables, sales, x 365 FY25 receivables. Days 54. That means it takes KFIL 54 days on average to collect customer payments. This is within healthy industry norms. Under 60 days is considered efficient for B2B manufacturing. What to watch? If this number rises, it could signal poor collection discipline or rising customer credit risk. If it stays steady or improves, that's a sign of strong operational control. Formula: cost of goods sold, average inventory, FY25 inventory turnover. Ratio: 6.1. That means the company turns over its inventory more than 6 times per year, or roughly every 60 days. This is a strong number showing high demand for products, minimal unsold or slow-moving stock, tight integration between production and sales. For capital-heavy industries, anything above 5x is considered excellent. So, these two key metrics give us insight. Receivables days, 54. Fast cash collection, inventory. Turnover, 6.1. Quick stock movement. Together, they suggest a short working capital cycle, meaning cash is not stuck for long. Less need for external borrowing. Strong liquidity to fund operations. These metrics often move quietly, but they signal deep truths about management quality and discipline. Suppose if KFIL collects in 54 days instead of 75, that's 21 days of sales freed up, possibly Rs 400, Rs 500 crore of cash unlocked annually. That cash can be used for reducing debt, funding CapEx, paying dividends, or simply earning interest. Working capital efficiency is hidden profitability. Receivables, days 54, efficient collections, inventory, turnover 6.1, very strong stock turnover. These numbers show excellent operational efficiency. The company is not just growing sales, it's running lean, collecting fast, and deploying capital smartly. That's how well-run manufacturers quietly outperform over time. Profits are one thing. What a company does with them defines its character. In this scene, we examine how Kirloskar Ferrous allocates capital and what it tells us about future growth, management priorities, and long-term investor returns. Kirloskar Ferrous has followed a balanced dividend policy, increasing dividend payouts gradually over the last decade, while retaining enough cash for internal reinvestment. In FY24, total dividend paid was Rs 91 crore, up from Rs 17 crore in FY16. This reflects growing confidence and maturing cash flows, but as the report notes, high payout reduces internal reinvestment. So the company must walk a fine line, rewarding shareholders without starving future growth. ROCE measures how efficiently the company converts equity into profit, and it's a key factor in determining how much can be safely paid out. In FY17, ROCE stood at 16%, but by FY25, it's moderate to 8.85%, mainly due to equity base expansion from acquisitions. This lower ROE reduces the company's sustainable growth rate, SSGR, meaning it can't grow earnings at a high pace without external capital or lower payouts. Sustainable growth rate answers this question. Can the business grow without debt or dilution? Between FY21 and FY23, KFIL's SSGR was strong, indicating a self-propelling engine. But as ROCE fell and CapEx rose, SSGR declined. This is not alarming yet, but must be monitored as the company digests its recent investments. Investor learning: strong SSGR = self-funded growth, weak SSGR = risk of future equity dilution or high debt. KFIL has invested Rs 336 crore in CapEx over 10 years. The key question: is this translating into higher returns and profitability? So far, returns like ROCE and ROE have dipped, but that's expected during investment phases. The real test will come post-FY26, when capacity utilization and EBITDA margins are projected to rise. Smart investors track the ROI on CapEx closely. It separates value creators from capital destroyers. So far, KFIL has shown reasonable capital allocation discipline, investing in vertical integration, rewarding shareholders, and staying debt-light. But with ROE and ROCE softening, the company needs to now prove that these investments generate returns, not just assets. For long-term investors, this is the inflection point to watch. Numbers tell us the past, but strategy tells us the future. In this scene, we decode how Kirloskar Ferrous plans to compete, grow, and sustain its position, not just for this year, but for the next decade. What we're really asking is this a business with staying power? Are they building competitive moats? And will this strategy translate into higher returns? Kirloskar Ferrous is a key player in pig iron, engine and brake components for automotives, ductile iron pipes for infrastructure, steel billets for industrial use. What sets them apart? They control the full chain, from mining iron ore to final machining. This vertical integration is their first major moat. KFIL owns captive iron ore mines, coke ovens, power plants, foundries. This gives it cost control, input price stability, faster client servicing. Even during raw material inflation, their margins remain stable because they don't depend entirely on the market. The company has evolved from a raw material supplier to a value-added manufacturer. Today it offers precision machined castings, alloy and ductile iron components, seamless pipes via ISMT acquisition. This shift supports margin expansion and de-risks revenue. Strategy is clearly shifting toward less cyclical, higher margin engineered products. KFIL has been aggressively investing in new casting lines, more foundry capacity, steel and pipe plants, power generation upgrades. This is long-cycle CapEx aimed at scale and operating leverage. As investors, we must track ROCE after these projects go live, whether margins improve with scale. Customers include Tata Motors, Ashok Leyland, and more. Automotive OEMs don't switch vendors easily. Testing cycles are long. Once approved, KFIL becomes a long-term partner. This creates revenue visibility, pricing power, and deep client trust, a rare intangible moat. KFIL's purchase of ISMT added seamless pipes and tube expertise, synergy with its steel production, horizontal integration across sectors. This expands their customer base and internal steel consumption. It's a classic peaceful investing move. Build long-term capability, not just headline revenue. KFIL is building its future with cost control, customer loyalty, product expansion, and vertical and horizontal integration. But strategy is only as good as its execution. As investors, track ROCE, OPM, and asset turns. Not just the vision, but the delivery. Behind every great company is either a great management team or a disaster waiting to happen. In this scene, we study the people running Kirloskar Ferrous. Do they have skin in the game? Are they trustworthy stewards of capital? Can we depend on their integrity and execution? Over the past 5 years, promoter holding in KFIL has remained consistently high. Year promoter holding percent FY21 59.65%, FY22 58.52%, FY23 56.63%, FY24 56.48%, FY25 50.90%. This shows long-term confidence and commitment, always above 50%. Not much dilution much. High and stable promoter holding is one of the biggest trust signals. It means promoters win only when shareholders win. There is no pledge of promoter shares in KFIL. Why does this matter? Pledged shares can trigger forced selling. It puts control at risk during downturns. and signals financial stress. 0. Pledging =, green flag. This is what investors love to see, commitment without compromise. Over the last 5-7 years, management has expanded capacity, acquired ISMT, integrated operations, and stayed on budget and on time, no major delays, no visible mismanagement. Even during peak CapEx years, ROCE stayed positive, a sign of solid operational control. KFIL management conducts regular quarterly earnings calls, segment-wise breakdowns, realistic, no-hype guidance, open disclosures about delays or margin pressures. This honesty in communication builds credibility. When management explains risks before they show in numbers, that's transparency. KFIL has reinvested profits wisely, avoided unrelated diversification, taken on debt only when needed, never chased glamour projects. There is no history of shareholder dilution or reckless ventures. This shows they prioritize value creation over vanity expansion, a rare and admirable trait. High promoter holding, zero pledging, transparent execution, prudent capital use. Kirloskar Ferrous checks all the boxes for management quality. A great business with a careless management is like a race car without a driver. Here, the driver is alert, honest, and focused on the long game. In our next scene, we assess how KFIL manages risk, debt, and liquidity. The safety net behind the growth story.
A company can still go bankrupt. Why? Because liquidity, not profit, is what keeps the engine running. In this scene, we check if Kirloskar Ferrous can survive economic shocks and manage financial obligations without stress. Why this scene matters. We ask, how much debt is on the books? Can they pay interest from profits? Do they have emergency cash if things go wrong? This is a resilience test, not about growth, but survival under pressure. Debt to equity, DE ratio. How leveraged is KFIL? Formula, total debt, shareholder equity, FY25, DE 0, 40x. That means, for every RS1 of equity, KFIL has RS0, 40 of debt. This is moderate and safe, especially for a capital-heavy industry like manufacturing. Investor insight, a DE below 1 = conservative capital structure. The company is not over-relying on borrowed money. Interest coverage ratio, ICR. Can they pay the bank? Formula, operating profit, interest expense. FY25 ICR, 5x. That means KFIL earns 5 times its annual interest bill. A ratio above 2 is considered secure. Higher =, more room to handle downturns. This tells us the company is not stretched. Even in weaker quarters, they can meet interest obligations. Current ratio, short-term liquidity buffer. Formula, current assets, current liabilities. FY25. Estimate, approximately 1. 3x. For every RS1 due soon, the company has RS1, 3 ready. This is a comfortable liquidity cushion. A current ratio between 1.2 to 2.0 is ideal. Too low =, cash crunch risk. Too high =, idle capital. Cash and equivalents, emergency funds. KFIL maintains a reasonable cash buffer as per credit and investor reports. This helps during raw material price spikes, wage payments, interest dues, market slowdowns. A healthy buffer =, fewer surprises. It acts like a shock absorber. Credit rating and banker confidence. Ratings from ICRA and KFIL remain stable in FY 24-25. No downgrades, no liquidity red flags, full access to working capital credit lines. This is a quiet but strong signal. Credit agencies trust their repayment ability. Financial discipline during CapEx. Despite spending RS4 336 CR in CapEx, debt hasn't exploded. Interest costs are under control. ROCE is still positive. This shows mature financial behavior, not chasing growth with borrowed time. Summary of key metrics. Debt to equity ratio 0, 40x, moderate, conservative leverage. Interest coverage ratio 5x, comfortable interest servicing. Current ratio, ST, approximately 1, 3x, solid short-term liquidity. Cash reserves, reasonable buffer. Emergency ready. Credit ratings, stable, trusted by lenders. Final takeaway, calm under pressure. KFIL's balance sheet shows strength and discipline, not just profitability. Their debt is manageable, liquidity is steady, and credit confidence is high. A good business grows fast. A great business grows without collapsing under its own weight. In our next scene, we look inside the factory, into what KFIL produces, and how efficiently it's using capacity to turn steel into profits. Behind every number lies a factory, a process, a product. What does Kirloskar Ferrous actually produce? And how efficiently are its plants being used? This scene reveals the physical core of the business, from iron and steel to castings and seamless tubes. Product portfolio. What does KFIL make? Kirloskar Ferrous operates across three major industrial verticals. Pig iron, basic form of iron used in steelmaking and foundries, acts as a raw material for internal needs, also sold to third parties, highly cyclical, linked to commodity prices. Castings, ductile iron, DI, and gray iron castings, used in automobiles, tractors, and heavy engineering. These are value-added products, higher margins than pig iron. Major customers include large auto OEMs. Steel products, post-ISMT acquisition, seamless pipes, steel billets, tubes for oil and gas, infra and industrial sectors. Acquisition of ISMT Limited added both product depth and cost control. Investor insight. KFIL is no longer a single product company. Castings and seamless pipes are higher margin and less cyclical. Diversification, equal sign. Revenue stability plus better customer stickiness. Capacity utilization. Are the plants running efficiently? This tells us how much of the installed capacity is being used to generate actual revenue. Segment-wise capacity highlights, FY25. Pig iron, approximately 400,000 TPA, 75-80% utilization, stable, cost optimized. Castings, approximately 150,000 TPA, 80-85% utilization, high, shows strong auto demand. Seamless tubes, approximately 250,000 TPA, 55-60% utilization, underutilized ramp-up post-acquisition ongoing. Why it matters. High utilization equal sign. Fixed costs are absorbed equal sign, higher operating leverage. Low utilization equal sign. Profits are compressed despite asset investments. Castings and pig iron are efficiently run. Seamless tubes have room to improve. An upside driver for future margins. Strategic moves boosting portfolio quality. KFIL's recent actions show it's not just expanding, it's evolving. ISMT acquisition. Added pipes, boosted integration. Coke oven plus waste heat recovery. Reduces input and energy cost. Focus on value-added products. Better margins, lower cyclicality. These steps move the company away from raw commodity play toward being a value-rich, process-optimized manufacturer. What investors should monitor? Product dependency. Over-reliance on one equal sign higher risk. Value addition trend. Are more profits coming from castings/pipes? Utilization percent. Falling trend. Equal sign red flag. Capacity versus demand. Are expansions matched by actual demand? Segment diversification. Smooths revenue in economic cycles. Final takeaway. A plant built for scale and strategy. Multiple product lines. High capacity usage in core areas. Margin-rich product transitions in progress. Strategic underutilization equal sign future leverage. The true sign of a scalable business is how well it sweats its assets. KFIL is showing us it can do that, and still has more juice left in the system. In the next scene, we measure how efficiently these operations are converting input into pure operating profit. Revenue tells you size. Profit tells you survival. But efficiency, that tells you whether this company truly knows how to run a business. In this scene, we explore how Kirloskar Ferrous manages its costs, operations, and profitability. Every rupee of revenue, squeezed for maximum value. Operating profit, EBIT, the core earnings power. FY25. EBIT, Rs 756 crore. EBIT is profit before interest and taxes. It shows how profitable the actual business is, before financing and accounting adjustments. This is the cleanest way to judge operational strength. If EBIT is strong and growing, the core business is working. Operating profit margin, OPM percent. FY25 OPM, 11.5%. Formula EBIT sales x 100. So Rs 756 CR, Rs 6 564 CR equal sign 11.5%. That's a strong number in a heavy manufacturing sector, showing cost control, pricing power, and scale. Investor insight, consistent OPM equal sign moat. Volatile OPM equal sign commodity risk. EBITDA, cash-based view of profitability. FY25 EBITDA, Rs 809 crore. EBITDA adds back depreciation to EBIT, showing pure operating cash generation. Used widely in valuation via EV/EBITDA. Removes noise. Shows what the business earns before non-cash and interest items. EBITDA margin, percent. FY25 EBITDA, margin 12.3%. Formula, EBITDA, sales x 100, Rs 809 CR, Rs 6 564 CR equal sign tilde 12.3%. a notch higher than OPM because depreciation is excluded. Stable margins mean plants are operating efficiently, scale isn't eroding profitability. Cost control, inputs and integration. The report highlights several cost-saving moves: backward integration, own coke ovens and mines equal sign stable input costs. Energy efficiency, waste heat, recovery equal sign lower power cost. Manpower rationalization, productivity gains, controlled staff cost growth. These moves reduce volatility, improve margins and build long-term resilience. How it affects you as an investor. If efficiency is high, strong cash flow, lower break-even point, more profit per hour's asset, higher market confidence. If efficiency is low, earnings vulnerable to shocks, higher fixed costs, weaker return on capital, volatile valuation multiples. Efficiency is the moat that protects margins, especially in steel, castings and pipes, where prices fluctuate but costs remain fixed. What should you monitor? OPM and EBITDA margin trends. Measure cost control over time. Input cost ratios. Raw material, energy and labor as % of sales. EBIT versus EBITDA gap. High gap equal sign more depreciation, asset heavy. CapEx ROI. Are plants producing profits, not just steel? Consistency. Efficiency should stay strong across cycles. Final takeaway. Strong margins, efficient cost structure, disciplined execution. KFIL is not just growing. It's growing without wasting capital. That's how a true wealth compounds. In the next scene, we'll wrap up with key strategic drivers, risks, and the long-term investment scenario for Kirloskar Ferrous.
Even good companies can hide silent risks. In this scene, we go beyond profits, into red flags, capital risks, and forensic signals that every serious investor must know. Declining ROCE and ROE returns yet to catch up. ROCE dropped from 22% in FY21 to 9% in FY25 estimate. ROE fell from 16% to 8.85%. These ratios have dropped, not due to poor profits, but due to rising capital base from CapEx and acquisitions. This is expected in investment phases, but must reverse post-FY26. Negative free cash flow, growth at a cost. Cumulative FCF from FY16 to FY25, negative Rs1,000 crore. FCF equals CFO minus CapEx. While CFO was strong, large CapEx in vertical integration and ISMT has made FCF negative. This is not a red flag if returns improve from FY26 onward, but it signals reliance on external funds during expansion. Capital allocation efficiency must improve. Retained earnings have grown, but returns, ROCE and ROE, are shrinking. If this continues, it suggests value dilution. Investor watchpoint. Management must now focus on sweating the invested assets. Forensic health clean track record. No share pledging, no major equity dilution, no audit remarks, no related party abuse found. These are hallmarks of ethical and transparent management. Summary risk dashboard. ROCE and ROE status. Declining should rise with asset utilization. Free cash flow, negative Rs1,000 CR, needs turnaround post FY25. Balance sheet, stress, low debt, DE stable at around 0, 4x, corporate governance clean, transparent, aligned with investors. Capital ROI, low so far, key trigger for valuation re-rating. Final takeaway, a watchlist stock with growth inflection ahead. Transparent accounting, low leverage, high CapEx-backed capacity, but returns must rise. Cash flows must improve. It's a story of high potential, but only for investors willing to track ROCE, FCF, and capital efficiency closely. How expensive is this company really? Let's go beyond hype and evaluate how the market prices KFIL based on its actual earnings. Understanding the PE ratio, the market's valuation lens. As per screener.in, Kirloskar Ferrous is currently trading at a PE ratio of 29.9x. This means the market is willing to pay Rs 29.90 for every Rs1 of the company's earnings. How to interpret this? PE of 10-15x means undervalued or cyclical. 20-25x shows growth confidence priced in. 30x plus means market expects strong future EPS. At nearly 30x, KFIL is not cheap, but it reflects a belief in its future, mainly driven by margins returning and capital efficiency improving. Earnings per share, the E behind PE. As per Screener, the TTM trailing 12 months EPS is R17.75. This is based on net profits earned over the past 12 months, adjusted for equity. If EPS stays at this level, the price reflects expectation of growth, because 30x is high for current ROE and ROCE. To justify a 30x PE, earnings must grow consistently, and returns on new assets like ISMT, seamless tubes must improve soon. Sector comparison. Are we overpaying? According to Screener peer data, most comparable industrial and ferrous metal companies trade between 15x to 25x PE. Large cap leaders sometimes touch 30-35x, but with stronger ROCE and brand power. So Kirloskar Ferrous is at the upper edge of the peer range. The price assumes improvement in return ratios, ROCE, ROE, and asset utilization. What can go wrong? If earnings don't rise or margins stay under pressure, this PE will compress, meaning stock price could fall even if profits remain flat. If CapEx returns lag longer than FY26, market may revise valuations downward. On the flip side, margin improvement, positive free cash flow, higher utilization of pipe casting units could all unlock upside from current levels. Investor insight: what PE is really telling you. PE is not just a number, it's a story about expectations. Right now, KFIL's 29.9x ratio reflects trust in capacity-driven growth, confidence in backward integration, concern on execution delay, and low ROCE. This is not a value stock. It is a growth transition stock. Summary dashboard. PE ratio TTM 29.9x, slightly expensive unless EPS grows. EPS TTM RS 17.75 stable but not yet scaling sharply. ROCE FY25 est around 9.34%, low. Must improve post FY25. Sector peer AVG PE 1825x, KFIL at upper end equals priced for delivery. Valuation view, fair to cautious buy, long-term entry if execution improves. Final takeaway. Don't just follow PE. Follow performance. A high PE stock is a vote of confidence. But if earnings don't follow, the price always corrects. KFIL is being priced for growth, not perfection. The market believes in its operating strength and capital investments. But now it's up to the business to deliver. The numbers are in. The story is unfolding. But where do we place our final focus? In this scene, we break down the key factors that will decide whether Kirloskar Ferrous becomes a long-term winner or remains stuck in transition. Risk factors. What could go wrong? Margin compression post. CapEx. OPM dropped from around 17.2% in FY22 to around 11.5% in FY25. CapEx hasn't yet resulted in proportional profit expansion. If margins don't rebound above 15%, returns on investment will remain dull. Declining ROE and ROCE. ROCE around 9% and ROE around 8.85% in FY25. Below the 15-20% gold standard for efficient businesses. Reflects underutilized capital. Needs strong bounce back post FY26. High working capital intensity. Receivable days 54. Inventory. Turnover 6. 1x. Funds are tied up in operations, reducing free cash for dividends or debt reduction. Debt-funded expansion. DE at 0. 4x seems fine, but most CapEx was funded by borrowings. If profit growth lags, even modest debt can become a burden. Weak self-sustainable growth rate, only around 1%, implies business cannot fund its own growth without external help. This undermines compounding, a key principle of peaceful investing. Forward-looking metrics to track. These are the green shoots to monitor every quarter. Margin recovery. Will EBITDA margin return to 15% plus? ISMT and tube plant. Utilization. Can new assets hit 80-90% capacity? ROCE. Trajectory. Are capital returns moving towards 15% plus again? Free cash flow reversal. Can KFIL start generating surplus cash post FY25? Debt reduction. Is management gradually deleveraging? Strategic scenarios. What could the future look like? Base case. Revenue RS7, 200 CR, OPM around 13%, driven by normal utilization. Risks include delayed ramp-up and inflation. Upside case, revenue RS8, 000 plus CR, OPM around 15% plus, driven by DI pipe and tube ramp-up. Smooth execution. Stress case. Revenue RS6, 300 CR, OPM less than 10%, driven by weak demand and cost rise. Risks include undercutting and ISMT issues. Final takeaway, where eyes must stay. Focus areas. Margin recovery, ROCE, ROE uplift, positive cash flow. Key triggers, ISMT utilization, EBITDA trend, receivables improvement. Caution points, margin delay, poor CapEx returns, rising debt. KFIL is moving from a cyclical commodity play towards an integrated industrial compounder. The upside is real, but only if execution is clean. Welcome to the final verdict. Let's tie together everything we've learned about Kirloskar Ferrous, not just the numbers, but the philosophy behind this business. Business quality, strong foundation, yet to bloom. Kirloskar Ferrous is a fully integrated industrial manufacturer. It controls everything, from mining iron ore, smelting it into pig iron, to casting components and producing seamless tubes. Vertical integration gives it cost control and supply security. Diversification into DI pipes and tubes adds value-added products, but it still works in moderate margin industries like auto castings and commodity steel. There's no brand moat, and working capital is high. It's a good business, but not yet a high-quality compounder. Financial health. Disciplined, but not efficient yet. Over FY16 to FY25, sales grew from RS1 114 CR to RS6 564 CR, around 21% CAGR. EBITDA rose from RS1 53 CR to RS8 09 CR, strong operating performance. But ROCE fell from 22% to 9.3%. ROE dropped from 16% to 8.85%. Why? Because the company reinvested heavily, RS1 000 plus CR of CapEx, but hasn't yet earned proportionate returns. Free cash flow is negative over 10 years, nearly negative RS1 000 CR. Debt is still moderate, DE ratio is around 0. For WACS. This tells us management is long-term focused, but we haven't seen the full payoff yet. Capital allocation, strategic but under pressure. Kirloskar Ferrous has used profits to expand capacity, backward integrate, and acquire ISMT Ltd. These moves are smart if they improve ROCE and margins, but if new assets don't deliver returns soon, it risks value dilution. The company is at a fork. Will it become a better capital allocator or just a bigger one? Valuation, not cheap, not overhyped. Current PE from Screener, around 29, 9x. TTM, EPS, RS17, 75, EV, EBITDA from report, around 7, 5x. This means the market is not treating this like a cheap cyclical. It's priced like a growth stock, expecting return ratios and margins to bounce back. This is fair only if earnings improve in FY26 and beyond. Risk flags, clean forensically, execution dependent. No pledging, no dilution, no audit or governance issues. Capital efficiency has fallen. SSGR's self-sustainable growth rate is only around 1%. High inventory and receivable cycles tie up working capital. These aren't red flags, but they are yellow warning lights that serious investors must monitor. Peaceful verdict. Is it investable? Kirloskar Ferrous is not yet a classic compounding machine, but it's a well-run, clean and expanding business with long-term potential. It's in the middle of a transition, from commodity plus cyclical to industrial plus integrated plus strategic. The ingredients are all there: capacity, backward integration, demand visibility, stable margins. But returns must improve, free cash flow must turn positive, and debt must not creep up. Final insight. Peaceful investing is about buying clarity, not just stories. Right now, Kirloskar Ferrous is a watch closely company, maybe a good pick on dips. Ideal for patient investors with a 5+ year horizon. Requires quarterly tracking of ROCE, FCF and working capital. Until returns rise, it's a transition story, not yet a peaceful compounder. Disclaimer. This video is for educational and informational purposes only. It is not a recommendation to buy, sell or hold any stock. All data is sourced from publicly available reports. Please consult a registered financial advisor before making investment decisions. If you found value in this deep dive, do support by hitting like and subscribe for more peaceful investing breakdowns. Drop a comment. Is Kirloskar Ferrous a future compounder or a cyclical in disguise? Share this with fellow investors who appreciate depth over noise. Until next time, stay informed, stay rational, and invest peacefully.